what you are analyzing. Know what you are analyzing. Setting the screen will help you, will help you cut the exact aspect you want to analyze. We'll focus on 2021 moving average. The tool we use for analysis. Then you also learn percentage calculation. And we are going to use proportion so that it will be easy. Then the 38.2 and 61.8 retracement. Totally 138.2 and 161.8 percentage extension. I won't talk too much about the Fibonacci retracement today. Read about it. Read about the Fibonacci and understand it. Then we'll use extension. We've never discussed about the extension. Let me use this one. Listen attentively so that we'll get this once and for all. A lot of you have been having challenges, technical analysis. It sounds so ambiguous, it sounds so complex. But if you understand percentage calculation and you understand this 138 and 161.8 extension level, these are the tools we use for the analysis for every kind of market. Gold, crude, any kind of other currency pairs, cryptocurrency, we use this. Understand this fact. Just try and get this clearly. If you've taken this down, let me clean it up. And okay, after this, then we'll do assignment. If you've taken this down, let's go. Let's proceed. Let's get down to chart analysis and disambiguate this ambiguity fast. Now, assuming this is your screen. This is the first thing we have to do. Assuming this is your screen. I hope it's clear now. This is your screen. The computer you use or the phone. I don't think the phone will be very, very okay for carrying out this analysis. But the computer, I'm sure. My reason is because your screen size determines the values you see. The size of your screen determines the values you see. And I told you that our focus will be on 2021 moving average. I'm not talking about the moving average indicator you use on the chart or on the platform. I'm not talking about the indicator because in forex trading, you can draw any line. You can just close your eye and draw lines blindly and you see the chart moving along that line. Any line, indicator, anything that is added to the chart has an influence on that chart, especially when you are entering the market. When you are entering the market, any line you draw have an influence. So I don't really use lines or indicator. Let me show you my chart so that you can see how clear it is. I'm going to take my time today. I won't be in a hurry so that I understand this thing once and for all. Because after today, I'll concentrate on my students only. Yes, this is how your chart should look like. My chart is almost empty. I just have one average line at the center. The line at the center is what I use as average. I'll always take my average as the middle. What is average? Average is the midpoint between 2 points or 2 locations. Average, center. So I always use center. You won't see my chart. You won't see me using indicators or drawing trend lines and all of that. I don't really believe in trend lines. Of course, it may work for some traders, but me, I don't really believe in them. So the size of your screen, talking about the size of the screen matters. When you through any broker and you open the trading panel, wow, most probably you have a very wide screen and you have the prices by the right. Prices by the right. These numbers you see by the right are equal intervals apart from each other, or have equal values. Have equal interval. Let me say, I have equal interval apart from each other. For example, the distance, let me say this 3, 2, 1. The distance between 1 and 2 is exactly equal to the distance between 2 and 3. That is what you see by the right side. Then, by the left side, you see, for the purpose of this, as use candlestick pattern. Candlestick pattern. Use candlestick pattern so that we understand the chart. Now, you are going to arrange this your screen such that the number of candlesticks that will appear from here, from where the price is displayed, to you arrange your chart such that from where the price is displayed to the left side, you should have only 120 candlestick displayed. And my reason is very simple. Because, don't forget, I'm a swing trader. Yes. So as a swing trader, we look for at least large price changes to enter the market. Day traders can just look for very little price changes and enter. But swing trading is the best, especially if you are not a high level professional or you just start trading. People that involve, or people that get involved in day trading and succeed are people that have very large capital, say $50,000, $100,000, $200,000, thereabout. They can involve in day trading because one, they can afford to take the risk, and then number two, very little price differences can give them the profit they deserve, and they also take very high risk. So for this kind of analysis, swing trading, we use the 4-hour time frame. Personally, I use the 4-hour time frame. Here you get to understand why we are using the 21 day moving average. Yes. Because if you look at the monthly chart, it simply indicates, or it simply tells you that in a month, this is what is going to be. Of course, this market is bullish. This is the US dollar against the South African rand, USD ZAR. This I'll use for example for today for proper illustration. If this is a bullish structure, that means for this month, this is what is going to be forming. This structure is going to be forming for 1 month. Whatever happens is that it's going to be like this structure. If the market is bearish, of course, it will be below, the market price will be below the center line, which is the average. As long as the monthly chart is above this center average line, it means the market is bullish. Even if it comes down somewhere here, as long as it is above the line, it is bullish. Listen properly so that you can set your screen. Why is my screen like this? If I remove this market watch, view, market watch, I've removed the market watch. Monthly time frame. You can see it is still bullish, but the values we have will be totally different. This is a monthly chart, but if I change it to 4-hour time frame, we also have something that is similar to reducing it. Now I'm trying to get you to understand why we need to reduce this number of candlesticks, because if you look at the candlesticks, if you count it, they are about 155, which is almost 2 days. And our target is getting a 20-day chart 20-day chart. That's why I using this 2021 moving average. For us to get the 20-day chart, personally, I inserted the market watch. Now, inserting the market watch, I've cut off some part of the screen, and the values you see by the right also change. Why? We need only 120 candlestick of 4-hour time frame to be 20 days. To be 20 days. How do we do that? How do we know? It is simply because sugar. Give me that phone, let me use as calculator. Give me that small phone so that I'll use as calculator. Let me calculate so that you understand why it should be 20 days. Our target is 20 days. No, I use the phone to do it. You want to see my wife? Don't worry, sweetie. Okay. Because if we have 120 candlesticks, and of course, we use a 4-hour time frame. This is a 4-hour time frame. There are 120 candlesticks, isn't it? Yes. How do we know that 4-hour time frame, 4-hour time frame of 120 candlesticks is 20 days? Very simple calculator. 4 hours, isn't it? Times 120 is equal to what? Is equal to 408. This is 480 hours. 480 hours, right? Then converting it to days, we simply divide by 24, isn't it? Now 480 divided by 24 is equal to 20 days. Yes. So when we have 4-hour time frame on we have 120 sticks candle displayed on a 4-hour time frame. That means the whole chart, what we are seeing is 20 days. What we are seeing is 20 days. What we are seeing is 20 days. I believe you understand that. We are still setting our screen. We are still setting our screen. If you are using a bigger screen, if you are using a very small computer, a mini computer, I think the screen size by default, you can reduce, you can zoom in and zoom out. Zoom to the level that you see only 120 candlesticks. If you don't get this right, whatever calculation or analysis you do will be wrong. We'll get different values. That's why at the end of this class, I'll give you an assignment to be sure that you understand what we have done. You will have exactly the same answer. If you don't have exactly the same answer, then there's a problem. That's why Forex trading, a lot of people have different answers because people use different screen size. That means they use different values and all of that for the analysis. But in this swing trading analysis, what we do here to get correct answer, is to have only 120 candlesticks. 120 candlesticks and not more. Anything beyond 120 candlesticks, you will have different values, and whatever you are calculating is different. Don't forget, we are using the 20-day moving average. 20/21. We are done with this 20 for the 20 days. Set your screen. If you need to follow, if you want to follow, if you want to meet up the class, if you want to join our class, all of that, set your screen now. Use the market watch. You can use any tool you like, but I use the market watch because it's easier. It's easier for me to shift and set the screen size. You can shift it, you can drag it to the left or to the right. Just make sure that the candlesticks you see is 120. When you have done that, this 21, although they call it 2021 day moving average, but me, I take this 21 as the period. What is the period? The intervals by the right side, the values by the right side, of course, the prices here. Monthly time frame. What you see, the numbers you see by the right, is the price, the changes in price, or the prices, either the ones that have occurred before. Yes, any price you see here have passed before long ago. Most certainly. Then we'll count from here. The values we see by the right should be 21. why should it be 21? Why should it be 21? Let me not go into too much details of why it should be 21, but having 21, because of course, by default, your default setting will come with only 20. What you see here, the values you see, how do I call it? Let me just call them values, but you understand what I'm saying. The intervals, the prices you see, the intervals between the prices, when you count them, there should be 21. By default, when you open your screen, after setting this, setting the candlestick, setting your screen size to have only 120 candlesticks 4-hour time frame to represent 20 days, which is exactly 20 days. How do we get 21 this other side by the right? By default, you have only 20. When you open an account or you open a trading panel, you see only 20 values. You see just 20 values by the right side. How do you get 21? You remove your taskbar. That if you have a system that displays 21, it's fine. If it is more than 21, it's too much. If it's more than 21, you have to reduce it. I don't maybe using a tab or whatever, but I prefer a computer system, because if you are using a computer system, if you open, you can only have much more than 20 days. You can reduce it by adding a market watch. Or if the values by the right, by default, you have the taskbar covering the ground, covering the 21st value. You have the taskbar covering the 21st value. It's very simple. Just go to your taskbar setting and then remove taskbar to the left. Yes. Remove this taskbar, put it on the left. If you see my screen, you see that the taskbar, this is my taskbar. I deliberately put it by the left side so that I'll have exactly 21 numbers by this side. There will be enough space to accommodate the taskbar. Number 3, the first we say 120 candlestick, right? Second, let there be 21 values to the right. Number 3, the volumes. Your volume should be thick volumes. If you don't understand, I told you I'll not be explaining too much today. Today I'm just going into the technical analysis directly. If you have been trading, you understand these things I'm saying. If you have not been trading, listen attentively so that by the time you answer this question, you will join the class where you meet students and other teachers that will explain all these ambiguous terminologies for you. But I don't have that time now, because the whole of this is still going to take off time, but you need to understand what we are talking about, which is much more important than all those definition of terms. The third thing, remove or use thick volumes. When you put thick volumes, you see it's just like bringing up some values that are supposed to be down. If you use thick volumes, you see, on the downside of your chart, you see like the shadows of items that happen down. It's just going to push some values up. Use thick volumes. If I remove these thick volumes, the values you see by the right here will differ. It will be different from what you can see now. So that is for the setting. Now, if you understand these 3 things we have said here. First, remember we said we are using 20/21 moving average. I've told you why 120 candlesticks is for the 20-day period. Our 20-day period, 4-hour time frame of 120 candlesticks is exactly 20 days. Then, for this 21, that's what me I take it. If you are reading some sources, they may tell you that it is 20 or 21. As for me, I explain it as, and that is how I understand it as Forex. In the Forex market, anybody can define whatever you like. But your answer is what determines. Are you a profitable trader? Once you are profitable, good. The analysis you do is very correct. You can't explain a lot of things and then after your analysis you fail or you lost. You can't tell me that is very correct. But this is how I understand this personally. 120 candlestick or 4-hour time frame is exactly 20-day period, which is true. Then the 21 here, I take them as the values by your right hand side. The value are the price. The prices, it may have passed that price, or if it's bullish, it may have passed that price. Most of them might be down. If it's bearish, it may not have gotten to the price. But however, ensure you can see 21 units by your right hand side. And then finally, number 3, use tick volume so that it's going to bring down other values. Personally, I understand is that this is the number of days, this time is supposed to be 24 hours. And then if you are using this tick volume and you see 21 values, then the tick volume can make it 24 hours. I think that is not something that a newbie will understand easily. Now we are done with this. Once you are able to follow these 3 steps, 1, 2, 3, to set your screen, you are sharp. You are ready to be in our class, because this is what we use to do every of our analysis. This is what we use to analyze our value. Once you can set your screen like this, you see exactly the same values I see. Any number I see. The first one, if the first one is 15.92 and the down one is, the last one is 3.35, you will have exactly the same value once you are able to set your screen in a way that you have 120 candlesticks displayed and 21 units of the prices. I think this should be okay. This should be okay. Let's get down to business now. This is just to set the screen. This is setting. Setting. Now, I believe that your screen is very set. Let's get down to business. Let's get down to business. I'm going to rush this percentage calculation. It's very simple. In mathematics, every language or some languages can represent sign. Let me just go straight to an example. If you are asked to find maybe 15% of what? Of 60. 15% of 60. It simply means 15 because percentage is over 100. Over 100. And in mathematics of is times. So times 60. I think it's simple enough. This 0 can cancel this 0. 15 times 6. 15, 30, 60, 90. 90 over 10 is 9. 15% of 60. Let me be sure. 15 divided by 100 equal to times 60. Yes, this is correct. So 15% of 60 is 9. Any number, when you ask whatever percent of anything, if you don't know it, just press calculator. Exactly as it was said. Right? Because obviously 50 is half, 50%, anything 50% is half. Because percent is 100, isn't it? So 50 is half of 100. So anything 50%, if you have 50% of 20, you don't need to crack your brain too much. 50% of 20 is 10, it's not like half of 20. You understand? Percentage calculation. But if the values confuse you, just follow it mathematically. Use the English of the mathematics. You understand? Use the English of the mathematics. Let me take another example. If you have to find 35% of 200, isn't it? It means 35 over 100 times 200. Any answer you get is correct. That is how to find percentage. Because in this forex trading, whatever we do, all the analysis and calculation we do is based on percentage calculation. Because those values you see, you can't just, there's no way you can know the exact value or know the price of a commodity, an asset, or a currency pair, except you use the percentage retracement. I'm coming to that. Let me not be too fast. Now, you've understood percentage calculation, right? Percentage calculation, you've understood. What is the next item? The next item, 38.2 58.2 and 61.8% retracement. Retracement. Good. If we have, let's assume this is the size of our screen. This is the size of our screen, right? And then we have the price of commodity or a currency pair. Start moving. We always use the beginning of the down part of the 21 number, the last part, the first number. Going upward, we use the first number. We assume that is where the price start increasing. Yes, in swing trading analysis, that is what I do. That is what we do. We assume that the price start rising so that when there is a retracement, what is retracement? Retracement is coming down a little. I won't focus on definitions too much. If you are a newbie, I'll give you an assignment at the end. When you answer the question correctly, come to the class and learn for free. You will learn most of these definitions. But for now, let's just focus because a lot of traders, a lot of people that trade have been waiting for this technical analysis to understand. They want to see if it's true or false. It is true, I'm very sure. So when you have a price of commodity moving from maybe from $10, let's have the price. Let's assume that the price is $10. 10 moves to 20 before coming back down. This is called retracement. If it continues going up, if it continues to 30. What is retracement? When you have the price of a currency or commodity or whatever going up, since a bullish structure doesn't mean it will keep going up. If it's only going up, the line will be vertical. It will be bullish, as we call it, going up, and then there will be a time when it starts coming down. It's not as if the price is falling. It won't fall. It will come down to a particular level, and then before it starts going up again. So this is called retracement. Retracement. Why is retracement important? That is the target of every trader to enter the market. The target. As a swing trader, as a technical trader, I analyze the market to enter the retracement. If you look at this chart carefully, this is the monthly time frame. The monthly time frame will enable us to see the chart clearly. If you look at this monthly time frame, this is bullish, right? If you understand what the bull structure is now, this is bullish. If you see the price starts going up, and after going to a certain level, there is a retracement. This is a retracement. It comes down before going higher again. So our target as swing traders is to enter the market when the market is retracing, when the market is coming, the price of the market is bullish, yes. The price is constantly going up, yes, no problem. But you can't enter the market then. You can't enter the market as an investor. You enter. You use a lot of money, of course. But as a trader, because of leverage and your margin requirement, which you also learn in case you don't understand much more about leverage and margin, you also learn in the class. Your margin requirement and the leverage are giving you may act against you. So you can't enter until you wait for retracement. When you wait for that retracement, when the price has fallen, fallen to a certain level, then you enter the market. That is where we have this. That is where we talk about these percentages. These percentages. Fibonacci, I won't talk about it much. This 38.2% and 61.8% are key Fibonacci retracement levels. Because if an asset moves from $10 to $20, we have 10 units apart, right? From here to here. 10 units apart. 10 units apart. That means for us to have 38.2% retracement, that means we will have a price drop, because this 10 units apart, of $3.82. $3.82. Let me calculate. If we have 10 minus 3.82, 6.8. $20 mark, is going to fall back to 6.18. This retracement will occur at 6.18. No, now this should now be 16 points. Yes, because the price starts at 10. So yes, this should now be 16.18. The price will fall to 16.18 before going back higher to 30. If it occurs like this, that means there have been a 38.2% retracement. 38.2%. 38.2%. How many percent? That is 38.2% of 10. Let this 10 not confuse you. This is the starting price. So the price rose just $10. So if there is a retracement and it comes to this 16.8, this is 38.2% retracement, then it keeps going up. If it is 61.8%, that means it's going to come down to, well, I'll talk about percentage calculation using proportion. Let me explain this. But I believe, I just want you to understand the concept of retracement. Once you understand this concept of retracement, Fibonacci, or in the Forex trading, where we use these key Fibonacci percentages, is where we believe that there's going to be a reversal in the market. There's going to be a reversal. If the market is bullish, and then by the time it becomes bearish, or when it starts coming down, that is why we say there is a retracement. There is a retracement, except there is a breakout and it becomes totally bearish. Otherwise, once it starts coming down, that is where technical traders analyze the market and wait to enter. That is when we do the percentage calculation. Because the percentage calculation of how much or how many percent it has gone for you to be able to enter these levels, 38.2 and 61.8. This 61.8% retracement level is always, or most of the time, most traders rely on this. But these two retracement levels are the best. These two, that is if you want to trade from the inside. Because if you are entering at this level, you should expect to take your profit somewhere back around maybe the 100%. You should be taking your profit somewhere here. This you are trading from inside. When you are trading from the inside of the chart, you follow the retracement, enter, you calculate and enter at the 38.2% level and 61.8% level. However, I do not mostly rely on it except the market is too clear or I follow the market for a very long time. Naturally, these are also very short distances. I use the extension levels. Now you understood the Fibonacci retracement. You understand how retracement work. However, I do not use retracement because I still see the prices, the price difference as small. It's not going to take time. Highest 2 or 3 days, you've gotten to the price, you are out of the market. But if you want to be very profitable, one of the skills, the best skill in forex trading is patience. Yes, it's patience because sometimes you may have to wait for up to 3 weeks, 1 month, 2 months, or even 3 months in order to enter a perfect market, in order to enter the market perfectly. You may have to wait for a very long time because of course you don't want to lose. What is the need of entering the market today, lost, tomorrow you lost, or today you gain, tomorrow you lost, next tomorrow. So it's just like you are taking too much risk. But if you are a swing trader, you should understand that it's going to take time. And the challenges that most traders face is if you don't have trading capital, you don't need to try trading. You don't need to use your feeding money to trade. You don't need to use money that is meant for something. Because sometimes, if you are waiting and you have to wait for up to 2 months, you should have that trading capital. Keep it there. Because it will be there because the day that the market will set, you don't have to start running helter-skelter. If you use money, if you use your feeding money, deposit in the account, and you wait for up to 3 weeks, 1 month, 2 months, there's no entry, you will use the money for your other runnings. But if you have capital, you know that the trading capital is the trading capital. It's not for any other purpose. If you don't have trading capital, learn it and have the skill to yourself. Whenever you have trading capital, you can trade easily. You trade easily and stress-free. You won't be under any form of pressure. That is what we do. And again, I decided to look for other volatile currency pairs so that at least with 100 US dollar, you should be able to trade. I'm not saying that it's not possible to fund the account with $30 or $20 and trade, but that is gambling. You can't use it in a swing trading analysis. If you have 100 US dollar, at least you should be able to trade currency pairs. Why you need such amount? Most people don't know. You just think you fund an account with $20. Why you need a reasonable amount is to keep margin. Is to keep a margin for you. Is to keep a margin. But you can use $100 to trade gold or cryptocurrencies like Bitcoin. At least you need at least $500. You need at least $500. And as a Nigerian, $100 right now is around 165,000 to 170,000. You know, so $500. You know how much it is. So let's get it.